I want to thank NinjaTrader as well as TradersWorld Online, Larry and Nick, for having me this morning. What I want to cover today is talking about price action. I want to show you some techniques that I use, how to trade the news, how to look at an ABC pattern that I trade, and really taking a look at the markets as a whole using just basic price action. If you have questions, morning Patel, if you have questions, go ahead and type them in the box here. I will answer them as I present the PowerPoint presentation. And if I miss anybody, you can always email me at support@DayTradeToWin.com. All right, before we begin, a little disclaimer here, making sure that everyone understands that there is risk when you trade. Please don't trade with funds or money that you can't afford to lose. Everyone should be aware of the risks involved in trading. If you have any questions about this disclaimer, please let me know and I'll further explain it to you as well. All right, what today's webinar is going to cover and include is price action trading, how to follow the price when trading. What I want to do is also show you some recent examples, as recent as yesterday and the day before yesterday, just to show you how things work using price action as well as using the Atlas line. I mentioned to you that I'm going to show you the ABC pattern. I want to explain to you in any market, whether it be the E-mini S&P or the Euro, how you can use the ABC pattern to know when there's a trend or when the day is going to consist of its normal activity based on this pattern. Trading the news as well. There's a specific way that I trade the news. I'm going to show it to you. Basically, I don't do what everyone else does. I do it a little bit differently, so you may want to stick around till the end of this presentation because you will learn specific setups and entries to help you trade. Also, we all think the same. We have the same mentality when it comes to trading. We all make the same mistakes, and so I want to touch on that a little bit on how we as traders look at the market, how we make the same mistakes, and hopefully we can avoid doing those same mistakes and change the way that we think about price and price action. E-mini S&P, right? Most traders trade the E-mini S&P and the Euro, financial indices here of the United States. I'm showing you yesterday's chart, May 16th, 2012. I always try to present to you the most recent chart activities when I present these presentations. I'm not going back a year or 2 years. Really, I want to look at the most recent activity. And if you look at this chart, it's pretty easy to see, yeah, I would have sold when it started to go down. I would have bought when the market started to rise. But where exactly would you have bought or sold? I always work on specifics. I try to be as objective as possible when trading, and therefore I have to know exactly where and at what price to go long or to go short. Now, looking back in history, we can see this and say, you could make up anything and say, I would have done this, I would have done that, but it's a little bit different as the market is developing what to do at that point in time. So this is yesterday on the E-mini S&P, and this is using the Atlas line software, exact entries of where you would have gone long and where you would have gone short. Market went up a little bit here on this long trade, not too much, but the real trade here was when it crossed the Atlas line and it started to fall and give you these additional signals. So not only does it give you the primary signals here, double bar short and double bar long, but if the trend continues, we have pullback trades, strength trades, denoted by the S's and P's, for additional trades. Now these are all filtered. They're built into the software. I recently updated the Atlas line. If anyone here has the Atlas line, either a lifetime license or a 6-month license, and did not receive the update, please email me. I'll make sure that you get the update and I'll license you properly. So this is the E-mini S&P. If you take a look at the euro currency, not much different as far as going long and going short, but definitely the market did not simulate the same environment as the E-mini. Similar, but not exactly the same. So here is a long trade. Here is a short trade here. And here's another short trade, and you have here a pullback trade here. So this is on the euro currency. And not only can you trade the day session or the US session, the US day session, but you can also trade the overnight, what I consider overnight, which is the London Open, where you can add the Atlas line to an overnight market, which would be the London Open or the Asia Open, and you could take advantage of the trades that exist based on when the Europeans begin to trade or when the Asians begin to trade, and you have plenty of opportunity at that point. And again, there are pullback trades and strength trades as the market continued higher for additional entries. Andre, the Atlas line is based off of price. There's no parameters. There's no parameters that you have to optimize. So I was looking for the word optimize. So there's nothing you optimize. You put it on your chart and it does the calculations for you. It's not based on any trend lines. It's not based on any Fibonacci's or any GANs or anything like that. It's really based off of the current market and what it's doing. So it's completely different, and it's software that's added to your chart for NinjaTrader. Now, I'm a firm believer that everything you ever need is being played out as you see it on the chart, and it will always tell you what's to come. So I'm not looking to add any type of moving averages or any type of MACDs or Keltner channels or Bollinger Bands. I never do any of that because all I really want is the price to dictate everything that I do. Having a blueprint to execute the trades is essential. Don't trade without having one. And what a blueprint is you know your exact entries, you know your exact stops, you know how long you're going to stay in the trade. Really, you have to have a plan before you enter into the market to know exactly what to do at each step of the way. So I always have a blueprint. Everything is specific. And trading price action is how successful traders do it. Nothing else matters. And as an example, I give this example all the time. I say, if you've ever gone to the floor of the CME and you look at the traders, the floor traders that are trading there, I've never seen anyone say to the broker next to them, hey, where's the Bollinger Band? Or, you know, what is the Keltner channel doing right now? Or where's that stochastic? I never see that. So I have to say that looking at how floor traders analyze only the time and the price, they analyze the board, what's happening, this is the way that you should be trading. Not adding 1,000 indicators to your chart and then trying to decipher what's what. Okay? What is the price telling you? Many traders fail to look at the price and just say, where's it going? What is it doing? I always follow the price. I follow what the chart is telling me and what the price is telling me, and I trade accordingly. So it's really important to look at the simple action, and I'm not talking about candlestick interpretation with shooting stars, and dojis. I'm not really concentrating on any of that interpretation, but I'm really just analyzing what is happening, where's support, where's resistance, what is the market doing, is it going up, is it going down, and it has to be objectively calculated. Let's talk a little bit about the ABC method. The ABC method is something that I do on a daily basis where I outline the day. I break up the day into 3 sections. Now you may be thinking, is this just for the E-mini S&P? And I say no. This can actually be done on any market, whether it be the euro or any other currency, or soybeans for that matter. Soybeans is a great market. Bonds, T-notes, really whatever you trade, whether it be the US session open or the Life Exchange open in London, or any other open on any market in any exchange. It really doesn't matter because all we're outlining is price. So now I have here the example of the E-mini S&P or the US financial opens, the indices, and the A part of the day is an outline of 9:30 to 12 o'clock. The B part of the day is from 12 o'clock to 14:30. And the C part of the day, the last part of the day, is from 14:30 to close. Now remember, these are in Eastern Standard Time zones, so if you live in a different time zone, you have to make the calculation to change these times. But really, it is the first 2.5 hours of whatever market you're looking at is considered the A part of the day. The B part of the day is the next 2.5 hours, and the C part of the day is from the last section until the close, which is typically about 2 hours, maybe an hour and 45 minutes, because the C part of the day is always smallest. So any market, as well as any session open for that market. What is normal is that price trades within a range of A about 85% of the time. And I'm going to show you some charts as well. So what's normal is that we see the middle part of the day, the B part of the day, in any market typically trade within the range of A. So 85% of the time I expect that. What I don't expect is the trend, or a trend to occur. Trends only occur about 15% of the trading year, and I want to be on the lookout for that. I want to see if the day is going to be a trending day, close higher, close lower, and when it does, I can pretty much tell early on that the day is going to be a trending day, and I can take advantage of that. So first, we're going to identify the A, and as we go into B part of the day, we're going to try to identify a trend early on. So let me show you some examples of that. I'm showing you the E-mini S&P, the first trading day of the year, 2012, January 3rd. Everybody woke up after the new year and ready to trade, right? And so here we have what occurred on January 3rd, 2012. So I'm going to outline the ABC pattern for January 3rd. And what we have is, first and foremost, A. This is the A part of the day, from 9:30 to 12 o'clock. Now, if you didn't know this was the E-mini S&P, this could be Treasury notes. This could have been the Australian dollar, right? This could be the DAX or the Eurostoxx 50. It can be whichever market. It doesn't matter because it works the same way. This happens to be the E-mini S&P. So we have the A part of the day, the first 2.5 hours. On January 4th, we have the following day another development, which we have the A part of the day. And then what we have is, again, it breaking out of the highs of A. So in the last slide, let me just go back here. We have on January 3rd, it breaking out of the lows of A. On the following slide, we have it breaking out of the highs of A. Now, you may think, really, what is the difference, or how do I calculate this, or what am I going to do with this information? Well, first, the one thing that you should know is that days work in consecutive fashion. So if you have a day that is a trending day, and you can see that A occurred, and then B, the middle part of the day, started to break out right away, I would say to you that normally we're going to have a few days in a row of trending days. You're going to see it happen 3 or 4 days where it doesn't matter if the market goes up or the market goes down. What matters is that there's a trend. And you may think to yourself, well, if the day went up or went down yesterday, I should expect it to go up or down again. That's true, but take direction out of the equation. Only think about, are we breaking the highs or lows of A? And you will be able to capture the trend, whether it goes up or down. So take the direction out of the equation and just look for this specific pattern to occur. Now this is in March 2012 here, and the reason why I have this slide is because I want to show you that I've outlined A here. This is the A part of the day from 9:30 to 12 o'clock, the first 2.5 hours. And then what we have here is B. And this is what typically occurs 85% of the time. B will be stuck within the range of A. This is what I expect. I don't expect it to break out. If it breaks out of the range of A, we have a trend occurring. Here we have 2 consecutive closes above the range of B. So what I'm showing you here is that you can not only take the relationship between what happens from A to B, but you can also take the relationship what happens between B here and C, the last part of the day. It's called the ABC pattern. C is also incorporated because what we're doing is taking the same relationship, what is the range of B between 12 o'clock and 14:30, and is the price giving me a late day rally or a late day sell-off? And if it does, we're going to have 2 consecutive closings. Some traders even tell me that they like when they see 1, but I like that extra confirmation. So 2 consecutive closings above or below the range of B, we have a trade. Anyone have any questions on that? Let's take a look here. No? Okay. If anyone has any questions on the ABC pattern, please let me know. I have probably close to 300 videos out there on the net. If you go to DayTradeToWin.com videos page, you can see these and other methods for free, showing you how I trade price action. You can always go to the YouTube page and see these videos as well. But really what we're looking at is A is here. B is here. If there's a trend that's going to occur, it's going to break out above or below the range of A. Typically it doesn't happen. When it does happen, I know we have a trend. Now we come into B. If there is a breakout above or below the range of B, again, I'm looking for that late day rally, late day sell-off if it occurs, and there's my trade. It's completely objective. Works on stocks as well. Yes, Patel. All right. And I invite you to look at the videos that I have which explain this in much more detail as well. Okay. Eduardo says here, do you only take on B and C? No, I I'm sorry, do you only trade in B and C? Eduardo, yes, I trade what happens in B in relationship what happened to A, and I trade in C what happened to in relationship to B. Correct. Okay. I'm waiting to see what happens in B, John. Okay. You're welcome, Patel. So let's outline the rules again. We have A is the outline from 9:30 to 12 o'clock. We have B being the outline from 12 to 4:30, and we have C, the last part of the day, from 14:30 to close. So what's normal is that price trades within the range of B when trading in C, 85% of the time. So pay attention to catch either a trend early on or a late day rally or late day sell-off. So how we trade and how we think. Why we all make the same mistakes. Have you noticed where you place your stops? Most traders place their stops at relatively the same place. Think about where you put your entries. Most traders also do very similar entries at the market in specific times and specific pricing. So do you place your entries and stops at the same place as everyone else? I have to say, most of you may do this already. So the majority of traders, they place their stops and they place their targets and they place their entries at Fibonacci levels that everyone is looking at, or highs and lows of the day or prior day, or even at even numbers. Okay? So if you're doing any of the above, you're really just doing what everybody else does. You're placing your stops at even numbers because it sounds right, or you may believe it's right. And so we're looking at not doing what everyone else does and doing something a little bit different than even numbers, than highs and lows of the day or prior day or even Fibonacci's. We're not going to look at that because that does not help us. Think about how the market works. If you see in this graph here, the price is definitely trying to go higher. It's just missing the mark here at 60. If you're long on this trade and you have a target at 60, how many times does the market have to attempt to get to 60 before it fails? Once, twice, 3 times, 4 times? This should be a clear sign that something is happening, that the market is not being able to continue higher. And if you're in a trade, this should be a sign to say, let me get out of it. Even if it's a tick or two before my initial profit target, this should be what you need to do. Now, front running is a word that's actually very bad. It's a very bad word because many traders think of front running as trying to deceive the market. And that may be true when you look at it with insider information, but all we're doing with front running is we're placing a stop or a profit target or an entry closer to what the market is showing us, that it can't get up to 60, and you're exiting the trade as it tries not just once but multiple times, and the key is multiple times. So for example, if you have 100 contracts that are waiting to be traded and 500 are waiting to be filled, then you're out of luck, because if the amount of contracts do not get filled and you're, let's say, number 300 waiting in line, then it'll just bounce off that and turn around. So when you see this happening once, twice, 3 times, 4 times, it should be a sign to say, let me get out of this, or let me get into it, because there is something internally changing. So front running a trade guarantees a fill where you would have tried for that extra tick and you wouldn't have made it. It's good for not only scalping but for normal trading as well. Now I'm showing you this chart here on March 6th because what I see here as the market goes down and down and down and down, I'm starting to see here once, twice, 3 times, 4 times. We're in a trend. This is definitely having a difficult time continuing. And if you have a profit target that is just below this, you should be saying to yourself, let me get out of this because I can see that not just by one candle, but by multiple bars, even here, it can't continue the move. So the key is looking at multiple bars, looking at the bigger picture. If you are unable to get this as it comes down, front run it, get out a tick or two in front, you're much better off for it. So have you noticed the market lately? How are your indicators doing, all you guys that use a ton of indicators in your chart? And I speak to a lot of traders during the day where this is how most traders operate. They have moving averages, they have stochastics, MACD, they optimize everything. They may be even using multiple time charts, 5 minute, 1 minute, 30 minute, 60 minute. Looks like a big mess. It's difficult to trade in that fashion. And the markets lately have been chop, right? Back, forth, whipsawing. It really makes indicators impossible to use. So how can we trade this up and down, then strong moves up and down? What can we use to help us with this? Well, let me show you an example of how price and indicators work hand in hand. Okay? So what I have here is an outline, a time outline, that gives you a representation of how an indicator, any indicator, works and how you take a trade based on that indicator. So the first part of this says here, price moves up or down, right? You see the candle or the bar go up and go down, and you do nothing, right? You do nothing because you're waiting for that indicator to plot. Then over here in number 2, finally that 5 minute or 30 minute or 10 minute candle closes, right? The bar closes, and only when it closes, the indicator then calculates, makes its calculation on what price just did. But what we're failing to see is that the move is over, right? The move is over. What we're doing is we're taking a trade based on something that has already happened. So now in number 3, price is now on a new move. It's going up higher, it's going down, or it's reversing. It's doing something else. But yet, you're not doing anything because you're only looking at the previous candle. And only when this new move occurs and closes, that's when the indicator plots. So we're always a step behind. The indicator will never tell you what's currently happening and giving you an option to enter long or short. It has to wait for that bar to close in order for you to say, okay, something happened, and now let me take action on that. So it's a reactionary effect that indicators have, and this is why we're always a step behind. So what occurs in price? Let's watch how it moves and flows. Instead of waiting for an indicator to tell us what to do, let's analyze it. Price action is more than just watching the price, right? It is ready and waiting and not to be blind. We have to see it happening and take action on it. You have to ignore all other influences. If you have the Bloomberg TV station on or the CNBC business and you hear the guys on the TV or on the radio say the market's terrible, the news is terrible, unemployment is terrible, everybody's terrible, then even though you may see something that tells you to go long, you're not going to want to do it because you're going to be influenced by what's happening around you. So let's turn off all these other influences, and instead let's just concentrate on the candles or on the bars, price bars. They are the ones that dictate what happens, not anything else. Indicators that try to catch moves will always be behind. I just showed you an example of that. So when price makes a move, the bar candle closes and posts. It's only then when the indicator allows you to understand what happened and then calculates it and then plots it and then tells you what to do. So the move is over. Price is now moving into another direction, and now we're sitting on our hands. Anyone have any questions on that? How indicators are a step behind? So let's take a look at how we follow price. How we should be doing it is looking at price going up and up and up, and we're not doing anything. What you typically do is you wait because you're saying, okay, where am I going to have the opportunity to sell this? When is my MACD going to turn red? When is my momentum going to go below 0? When is stochastic going to fall below 80? Whatever you do, you're usually waiting for something to happen. And then here, price is still moving higher. And you're probably still thinking, wow, where am I going to sell this? Right? I want to sell it, but where? And then as the market moves higher yet, you're probably thinking to yourself, all right, I didn't buy it when it was low. And instead, you're now thinking, where's this top? If you would have just followed it in the beginning, when the market was telling you something, you would have seen that it's going higher. Market's going higher, and we need to take advantage of that. So what are you going to do? Will you buy the market if it's too high? You may think it's too late. Traders normally don't. We all think this way because they believe they're entering at a high point or where it's too high. Price is still moving higher, and you think, wow, I should have entered. Well, you see the market moving higher, and that gut feeling screams at you and says, I missed the move. Finally, you decide to enter, and guess what? Now you enter, and you enter at the highest point of the day, and you lost out on the entire price move because we refused to see what was really developing on the chart. If the market is telling you anything, you should follow it. If it's telling you where it's going, listen to it, watch it, and trade it. Now, how do the pros trade? Well, good traders never stay in a trade that goes against them for an extended amount of time. If this is one of the things that you can take out of this webinar is that holding on to a trade for longer than it's worth is definitely a bad move. Because we enter for a reason. We enter because we saw something. Something told us to go long. A setup occurred. A trigger occurred. And if it doesn't go in your favor, for whatever reason, it could be any reason, the longer you hold on to it, the worse off you are. So I like to say, I get in for a reason. If it doesn't go in my favor within a certain amount of bars, typically I look at 4 to 5 bars, I'm out of the trade. I tried it. I'd rather get out at a break even, a small win, a small loss, instead of holding on to it, because if this turns out to be a catastrophe against me, where I could have gotten out early as possible when I figured out this wasn't going in my way, I call that a time-based stop. Professional traders never use the same tools as the average Joe to trade. And so you'll never see the normal trader use anything other than what's typically out there. Moving averages, stochastics, MACDs. Professional traders don't use any of that stuff. All the traders that I worked with, they could care less about the stochastic. Right? They never said, hey John, where's that moving average? I need to know or else I can't trade. They never said that to me on the floor. So I have to say to you guys, let's look at something else besides what everybody typically uses. Contrarian thinking. Don't follow the herd, right? You probably heard it before, but if you follow the herd, it usually leads you to slaughter. And I'm going to show you a few ideas, especially on how to trade the news, where contrarian thinking is and will always be the best bet when trading in this fashion. So chaotic markets. Think about what occurs during this kind of movement. Can you really trade these crazy moves? The market is chaotic, it's volatile. You should understand when it is and when it's not chaotic and volatile. Think about what's happening. You really can't trade these kind of crazy moves. They are almost impossible to get good fills, good exits, and they will run through your stops, and you're going to be in very bad shape, especially during a news event. So when I see a chaotic market, especially after a news event sets it off, I step back. What about slippage? I don't think it's worth trading during these times. I want to trade under rational behavior, not when it's irrational. So trading during news events, oftentimes we as traders try to follow the crowd, right? You see everybody buying right as the news event occurs, and what do we say? I gotta get in there, gotta jump in, right? I don't want to lose out on the move. The news event does not always concur with the market action. And so if you're waiting for a news event and you actually have an idea set that if unemployment is negative, that the market's going to go down, or if housing starts are bad and the number is bad, then the market should go down, you'll be surprised that many times there is no correlation of the actual number that the news event occurred or that it produced to what actually happens in the market going up or down. It's interesting because you may think that it's a surefire way to jump in. Not always the case. So trading the news, never assume that a positive news equals a bullish move. Never assume that a negative news equals a bearish move. Always watch for the calm before the storm. Typically, just before a news event, I want you guys to expect the market will begin to tighten up a little bit. So it's if you're in a trade and you haven't gotten out yet, just prior to that news event, I would look to exit just before a chaotic move is about to happen. Countering the initial move is always the best option, but not just blindly going against it. We have to wait for a proper setup. So I'm not recommending just blindly selling when there's a good news event that occurs. We have to wait for the proper setup. What I use, and actually you can use any economic calendar, but I prefer, been using it for a number of years now, the Bloomberg economic calendar. It's free. And you can use the Forex Factory, use anything. They all have the same information. I always want to know when a news event is about to happen. If a news event's going to happen, then I need to be out of the market just as it's going to happen. So today, for example, jobless claims at 8:30 and Philadelphia Fed survey here at 10 o'clock. If you're looking for a move to occur, we're going to look for this to occur and stay out of the market until it's just about finished happening. So I use the Bloomberg report, and I always know when a news event occurs. I also never trade blindly during a news event. I mentioned this because I never know what's going to happen. So if you think that the market's going to go up, if you think it's going to go down, that's almost having some blind trust that something is going to occur. So I never do that. I never do that. Also, red stars or red flags are very important. These are the only items that I stay out of the market for. Everything else, orange stars, and all these other reports, to me, they're really not a big deal. So red stars are what moves the market. Okay? So take, for example, today, which I'm going to show you in a moment. But before I go to today, I'm going to show you some recent news events. Never jump in with a market order. Wait for price to come all the way back from where it typically was already. Wait for pullbacks and a strength if price takes off. Sometimes a positive news event, the market rockets and it just keeps on going. Never act on impulse or reaction to the news. Here is May 15th, which is 2 days ago. Consumer Price Index 830. This is a news event right here. Right? This is a news event. There's no doubt about it that everybody saw this bullish candle and went long. And if you went long, this is what happened. Rudolph says here that many times news are already priced in before they occur. It's possible. It's possible. But how would you have taken this reaction? Because that wasn't priced in. This was a huge chaotic move that happened based on the news, Consumer Price Index. So there was a reaction. And that's what I'm looking for, a reaction. So the typical trader, not to say anyone here in the room does this, but the typical trader will see this as it's happening and say, I'm buying it because this looks great, right? Well, if you bought it, that's what happened. So how I do it is I actually take account for the actual chaotic move that occurs, this large green candle, and I say to myself, first, was there a reaction to the news? And not only was there a reaction, was it chaotic? Chaotic means much larger than the bars that came prior to it. And I could see definitely that this candle is much stronger or larger, bigger range than any other candle prior to it. I think it's unnecessary to even look at volume at this point because all we're looking at is as soon as this candle closes, I just want to see Tien if it was a large move or not. Reaction to it. So it's really unnecessary to look at the volume. I just want to see if there was a reaction to it, chaotic move. So I look at that. I look to see if there was a some type of reaction. And then I look at if this candle was green or if it was red, right? Everything I do, I try to keep it as simple as possible. And so instead of saying higher close and open, lower close and open, let me just say to you, is it green or is it red? And it's green. So I know there was a bullish move. And so if I know it's green, then I'm going to look to do the opposite. So know ahead of time when the news events occur. We look at the Bloomberg report or any other economic calendar. Is the immediate reaction, chaotic. So I'm not looking for anything that happens 10 minutes or 15 minutes later. I'm looking for the immediate reaction. If there's not a reaction, if there's nothing that told me that everybody bought and sold chaotically, then this setup does not exist. This setup only works when there's some type of chaotic move based on news. If there is, then I will take the opposite direction of the chaotic move. Hence, is it a green bar? Is it a red bar? It's a green bar. I want to go short. What I use as proof is 2 consecutive bars below the low of that green bar to enter. That's what I use as proof. I use price, right? I'm not using anything other than the price itself. So if you look at what occurred here, you have the chaotic news event, you have everybody buying, and then you have 1 closing below the low of that bullish candle, 2, I'm short, right? I'm short. Very easy, very high probability. It's not even one of the best methods that I have to trade. I have other things that are much more high probability, but this is an actual way that you can use price and news to get ahead of the curve. I would go short at the close of the second candle, Patel. The close of the second candle. You need proof that this is happening. Now, I am going to explain to you why this happens, okay? Because there's a reason why this happens. And this is actually the idea behind it. Okay, so it's not just arbitrary that this occurs. This occurs for a reason. The reason is, think about, let me just go back here. Think about all of the traders that went long based on the number, the consumer price index value that came out. So the reaction, the number must have been positive, right? The number must have been positive. Now, if they all bought, right, the normal retail trader bought, and they were wrong, what is it that they have to do? What is it that they have to do in order to get out of this trade? There's nobody else there buying. They have to cover this long position by getting stopped out by reversing. Right, they got a short cover. And what happens is they fuel the market in the opposite direction. It's unfortunate, but I'm taking advantage of when traders are wrong and they have to cover their longs here, or short covering, right? And this is what happens. So there's a reason why this candle is so large. The reason is everybody's getting stopped out and reversing, and that's where I take advantage of the move. Makes sense, right? So I know exactly where to go long or where to go short. Now, if this was a red candle, I would do the same exact thing. I would have done if this was a red bar, I would have gone short. I'm sorry, if this was a red bar, I would go long, the opposite. So if this was a red candle, lower close and open, I would go long at the highest high of this bar. Okay? John, I would not just jump in. I need to use proof, right? So I'm not willing to just jump in at the first sign of this beginning to turn red. I have to wait for proof. Now, some of the traders that I work with, they like to go in on the first candle. That's fine. I need a little bit more than that, though. I need 2 consecutive to go short. And even though I got in here, this is 5 points here, pretty much, or 4 points. I'd be very happy with 4 points within 10 minutes. 5 to 10 minutes. Not only that, you're going to have this becoming some type of support. So if it comes out and it comes right back in, this is your opportunity, which I call a prove it stop, to, if you do go long or short and it doesn't continue, as soon as it pops back above here, then you'd be out of the trade. So you also have to protect yourself, and you're using this as the median line to say it's got to hold and come to my profit target. But if you go long or short and it comes right back into this range, you would be out of the trade. Okay, John, is that clear? Now, if you don't believe me, today there was an economic news event which occurred at 8:30 here, and let me just take a look here. Jobless, right? Jobless claims, right? What do you think? Here's 8:30 today, right? Today. Jobless claim. Tell me what color that candle is, right? I'm going to try to keep it as simple as possible. Color's green, right? So if that color's green, what am I doing? I'm going short when 2 consecutive candles are below there. Very simple way to catch what happens. Okay? Now, take a look at it for yourself. Go back in history. Don't take my word for it. I'm showing you today. I showed you yesterday or day before yesterday. It all works. There's no mystery here. All right. Before I end this program here, as we get near the end of the presentation, I have numerous courses. If you use the coupon code TradersWorld, you can get 10% off any of the courses, whether it be the Power Price Action DVD course, which comes with 8 weeks of training with me, 8 weeks of training with me, or the At the Open method or scalping methods. They're all based off of price. And the Atlas line, which is proprietary software. I invite you to take a look at the website, take a look at the over 300 videos I probably have on trading. Email me any questions you may have. Bill, if the doji is the news event, I look at the following candle. So if you're looking at today here, this is the doji. Actually, the doji is all the way up here. I would look at the next candle, be green or red, because the doji gives me indecision. So I have to base it off of a chaotic move, which is green or red. It would be this next one. Okay. I think that was for Bob or Bill. And thank you, John. As well as Bob says here, came in a bit late. Are you entering as soon as the low of the initial impulse candle is breached? No, I'm entering 2 consecutive closes after the low of this green candle. So it has to be 2 consecutive closes. At the close of this candle, this is my entry. That's my entry. All right. But, I have videos on this which explain this in much more detail. I try to cover a lot here in this webinar. If you are confused on anything, check out the videos. I offer these videos for free. If you opt in to my mailing list, you get these videos on how to do this in much more detail than I have time to do today. And I wish everyone well. Enjoy the rest of the Traders World here and the other presenters. And I thank NinjaTrader and the TradersWorld gang having me speak today. Thank you, Dev. Appreciate it. You got it. Appreciate it, guys.